Okay, let's go.
Here is a long position on the euro to dollar pair. The setup looks solid until the price suddenly snaps below support and starts diving toward your red stop-loss line. Your next move determines whether you are operating as a professional trader or a gambler. These specific moments of high-pressure decision-making destroy more accounts than bad strategies or poor risk management combined. A trader's internal, psychological refusal to admit they are wrong represents the single greatest threat to their capital. This reaction is driven by ego, the biological tendency to tie our self-worth and identity to being correct. This chart illustrates loss aversion, a concept in behavioral finance where the brain registers a loss as twice as painful as an equivalent gain feels good. When ego and loss aversion collide at the stop-loss line, your biology interprets a losing trade as a literal physical attack. To bypass this trap, we have to look at two different ways of processing the exact same market event. Trader A views the price drop as a personal defeat. Because they cannot accept being wrong, they refuse to close the position. They slide the stop-loss further down the screen, widening the danger zone to avoid the immediate sting of the exit. As the price continues to fall, Trader A adds to the position, doubling down. They rationalize this by telling themselves the market is making a mistake and most reverse. This is the behavior of an injured boxer who refuses to admit they're hurt. They throw wild, desperate punches, leaving their chin completely exposed. That fighter inevitably gets dropped because they lacked the humility to defend and adjust to the reality of the round. Trader A's account is breached because they prioritized being right over being disciplined. Now look at Trader B watching the exact same price action. When the market hits the stop, the trade closes instantly. Trader B accepts the planned loss without hesitation. They immediately journal the trade, documenting why the setup failed, and treating the loss as a single data point in a larger system. Trader B is the disciplined fighter who takes a hit, steps back, and raises their guard. They protect their energy to fight the next round. Following the rules builds long-term consistency. By taking a small loss, Trader B preserves both their capital and their mental clarity. The difference in these two reactions is the result of biological conditioning. Carol Dweck's research on the growth mindset relies on neuroplasticity, the brain's ability to form new connections based on repeated behavior. When you repeatedly treat a loss as data rather than failure, you strengthen the logical pathways in your brain, while the emotional pathways associated with panic begin to fade. Over hundreds of trades, this repetition makes the disciplined response your default setting, effectively reducing the emotional distress caused by a red chart. By utilizing this biological process, successful traders learn to respond to losses as technical events, allowing them to remain objective while others are overwhelmed by emotion. The market will eventually humble every person who participates in it. You will either be weighed down by the need to be right, or you will adapt through a focus on growth. The next time you are in a losing trade, ask yourself, am I protecting my account or am I protecting my ego? Choosing to protect the account ensures you have the capital and the focus required to execute the next trade.